Good morning and welcome to the first 2026 edition of the Main Management Weekly Market Note. I am Alex Varner, our head of research here, flying solo this week as we are getting back into the new year. We hope everybody had a great holiday and are ready to go come January 5th. The menu of our ETFs, as always, by W, TMAT, SECT, and INTL. One note, we are no trade fee or no ticket fee on LPL as of January 1st. So that's a note and a good development for those of you who access us via that platform. Getting into the performance data for the year to date, we have a whole 1 day of trading. But as you can see, emerging markets up solidly 2.8%, leading the way. NASDAQ down 0.2 for the sectors. The energy sector led the way up 2.1. That's seeing some more more price movement today with the Venezuela developments. On the sector side, down to the downside, communication services and consumer discretion down the most. So that's kind of the year-to-date 1 day performance. On the recession dashboard, not a ton changed over the week. It was a very light week on the data front. So we're kind of overall, on the upper end of the mid range there for the recession dashboard indicators. The data points we got pending home sales. Those were up 3.3% month over month, solidly above forecast for a 1% increase. This marks the fourth consecutive monthly increase in a row and brings the 6-month average to its highest level since October of 2021. So good to see those pending home sales increase. Those generally translate into existing home sales as the transactions complete. On the right, we show the index itself. It's all the way back up to 79, well, all the way being a relative term, but back up to 79.2, which is the highest since February of 2023. And it's up 2.6% year over year, kind of in that choppy, accelerating uptrend that we've seen over the last couple of years. One thing of note in here on the home sales is we're hitting an inflection point between the percent of people who have, or the percent of homeowners who have a 6% mortgage rate versus a 3% mortgage rate. So as more and more homeowners, as time continues, come in and have 6% mortgages, the incentive for them to move is lower. Thus, you think that maybe that'll free some inventory and some sales action up as buyers step in, because if you have a 6% mortgage and the core mortgage rates are at 6%, just above, so there's a lower incentive or a lower hurdle for you to move to sell your house, because it's not as if you're going from a 3 to a 6. From a 6 to a 6, it's a lower hurdle. So we should see some inflection there. I think even with the kind of quote frozen housing market you've still seen, I want to think it's 4 to 5 million transactions per year, which has resulted in that steady mix shifting in favor of the kind of higher mortgage rates, and that'll continue as time goes on. So hopefully we start to see some freeing up in this housing. However, as you can see here, the home price indices are basically at or near all-time highs. On the left, we show the S&P Case-Shiller 20 City Home Price Index, which continued higher to 339 in October, but it slowed on a year-over-year basis to 1.3. That 0.3% month-over-month increase, though, was the biggest since January of 25. We saw some reprieve in there, and now we've started to see it kind of tick back up. And similar picture on the right with the FHFA House Price Index. That's mortgages that are guaranteed by Fannie Mae and Freddie Mac. But that's at a new all-time high of 437. On a year-over-year basis, though, it slowed to 1.7% year-over-year. That's the smallest rise since March of 2012. So despite the kind of favorable shift in the mortgages, home prices remain very elevated, which again is hampering affordability. Hopefully you see some relief here, but again, we were seeing some and now we've kind of ticked back up. So not continuing in the direction we'd hoped, but we'll see what that goes going forward into 2026. The Dallas Fed Regional Manufacturing Index moved lower in December, with both general business activity declining to minus 10.9. That's the lowest since June of 2025, and that future activity ticking lower down to plus 10.8. On the right, though, we show kind of the aggregate prices paid index for Dallas, Kansas City, New York, and Philadelphia. You can see the individual lines, but that dark black line is the kind of simple average of those, and it's good to see those rolling back over after kind of that acceleration we saw from January to middle of last year. And that is a good sign for inflationary kind of forces moving back lower as we want to see inflation continue to moderate here. So this is good for that. And then on the kind of broader regional manufacturing indexes, now that we have all five through December, on the left we show the current, and on the right we show the future activity indices and their simple averages. Current picture is a little more contractionary than expansionary, with only Richmond improving in December. Simple average declined to -6.2, which is the lowest since June, but the future activity picture is considerably better. You saw Dallas and Philly decline, but despite that, the average is up to 23.4, which is the best since January of 2025. So the outlook for future activity is rising, even if the kind of current levels are a little bit more contractionary. But hopefully, that future optimism feeds into the current figures. We got the weekly initial employment claims, which fell. On the left here, we show the initial unemployment claims at an absolute level. Those fell to 199,000 for that last reading we got in 2025, well below forecast for a 220,000 reading, and the second lowest figure since January of 24. That 16,000 week over week drop was the seventh decline in the last 8 weeks. You did have a spike there, but despite that spike, the 7 of the 8 weeks being down have resulted in a net decline of 30,000 claims. So no signs of stress here, kind of on the higher level, the higher frequency employment claims. The non-farm payrolls we get at the end of this week for December, or we're supposed to get at the end of this week for December. So we'll see what comes with those. I think forecasts are looking for like 60,000 on average there for the non-farm payroll headline figure. Then here are the continuing claims as well. You can see coming in, finishing the year lower than what we saw for most of, kind of the middle months of the year. But they trended down to 1.866 million. That's the second lowest reading since April on the left for the absolute. And then on the right, they fell by 47,000 week over week. That's the fourth down week in the last 6. And over that time, continuing claims have declined by a net minus 87,000. So again, initial and continuing unemployment claims trending lower to end the year, kind of no labor market warning signs here, which is a good thing. You want that to keep going forward, and you don't like to see those claims spiking. So in summary, as we said, a light data week, but pending home sales up 3.3% month over month, bringing the index back up to 79.2, which is the highest since February of 23. Both the S&P Case-Shiller 20 City Home Price Index and the FHFA House Price Index continued higher in October and are at or near all-time highs. However, they are slowing on a year-over-year basis, and you hope to see maybe, I don't know, we were hoping to see that kind of break in the pricing continue, but it didn't. It's ticked back up. But as you get the mortgage shift, as a 6% versus 3% anchor continue to shift favorably, hopefully that frees up, some of the housing market. The Dallas Fed Manufacturing Index declined for both current and future activity indices in December, but prices are rolling over in aggregate, which is a good development for prices paid are rolling over in aggregate, which is a good development for inflation. And finally, initial and continuing unemployment claims finished the year on a good note, falling to the lowest levels in quite some time. So we look to see, hopefully that continues. The key data we get this week, finally kind of back into a full week of data with the first full week of 2026. We get the ISM manufacturing PMIs, the JOLTS. We get job cuts and labor productivity on Thursday, and unit labor costs as well. And then on Friday, the big kind of number that people are looking at this week are the non-farm payrolls for December, which hopefully will be a little bit more complete report given the kind of government shutdown, the resulting data, inconsistencies that occurred in October and November. So that's it. We hope you have a great start to the year. And please reach out with any questions you have. Thanks so much.